Right, well, welcome everyone to today's installment of the SoFiE Seminar Series. I only learned a few days ago that it's a public holiday here today in this environment. Who knows when it's a public holiday, when it's a weekend, when it's a weekday. But for those of you in the US enjoying your Labor Day long weekend, I hope it's been good so far, and I hope the next hour is also a good part of it. Today's speaker is Gustavo Schwenkler from Santa Clara University, and his discussant will be Daniele Bianchi from Queen Mary University of London. We'll use the same format today as we have in past weeks. The speaker will have 40 minutes to present. The discussant will have 10 minutes at the end for questions and answers. If you have questions, you can ask them either by raising your hand, and you can raise your hand by going to the participant button at the bottom of the screen, and there's a little raise hand feature there. Or you can use the Q&A button down the bottom, and then I can see your question, and when Gustavo takes a break during his talk, I can call on you to unmute and then ask your question. So with that, I'll turn it over to you, Gustavo. If you'd like to share your screen, you can begin.
All right, well, thank you so much, Andrew. This is very exciting. Let me do this here. All right, there we go. Okay, great. Well, this is joint work with my PhD student from BU, Frank, and essentially what we want to figure out, what we're after is trying to understand what drives covariation in cryptocurrency returns. If you read the paper, this is going to be a slightly different pitch to the problem. We're currently revising the paper, so any feedback is highly appreciated. So what do we know? Well, cryptocurrency markets are, of course, a new investment class that has drawn significant investor capital. Currently, there are about 6,000 cryptocurrencies that trade in over 380 exchanges. I checked last night, the aggregate market cap of cryptocurrencies is about 300 billion, and the aggregate daily volume of cryptocurrencies and lately has been around $100 billion. These are really big markets. And what we know from the literature is that these markets are liquid, they're highly responsive to information, and very speculative. And Daniele, who's my discussant, has also done work on this. So I'm very excited about his discussion. If you look at the volatility of cryptocurrency markets, it's huge, both at the market level and the crypto level. On average, we observe, at least within the universe of cryptos that I'll be talking about, weekly volatility is in the range of 15%, and idiosyncratic volatility is in the range of 10%. So these are really, really large swings that can happen at any point of time. So if you're an investor in cryptocurrency markets, then you really want to understand kind of what drives covariation in these returns. To kind of do proper risk management or determine your portfolio allocation. Now in the literature, there's been a couple of there's actually not been a lot of work trying to figure this out. There's been kind of two channels that have been proposed to explain what drives covariation. One is kind of a standard kind of factor model, and there's kind of market size and momentum factors and other factors that have been proposed to explain cryptocurrency returns in the cross section. Recently, Amin Shams has a paper where he looks at kind of correlated demand shocks as a source of covariation. And the way they go about this is kind of interesting. They think about cryptocurrencies that are co-listed in common exchanges, because a lot of there's so many exchanges where you can trade cryptocurrencies. A lot of these exchanges have restrictions as to which kind of investors can invest or can buy cryptocurrencies through those exchanges. So the assumption there is that if you have, say, cryptos that are traded in one exchange where only, say, investors from Japan have access to, that those investors are going to be very different than the investors that invest in cryptocurrency exchanges that operate in the US. So there's these kind of covariation through the fact that there's kind of clientele effects. Now, what we propose in this paper is kind of an alternative channel to explain covariation, and it's kind of thinking about peer linkages in cryptocurrency markets. Now, why do we believe that peer linkages should matter? If you think about it, in the long run, no arbitrage theory tells us, of course, that similar assets should hold similar prices. But in the short run, there can be, of course, deviations from these from this one price kind of rule in response to large unexpected shocks. And there's kind of two theories or two mechanisms that are at play when these large shocks occur that have been discussed in the literature. One mechanism is kind of a contagion mechanism that says that when say a big shock hits one asset, that investors extrapolate that similar assets should be experiencing the same kind of distress, and therefore the prices of these similar assets co-move in the same direction. So this is kind of an information contagion kind of effect that is at play here. An alternative channel is a competition effect, whereby if these assets, similar assets, are substitutes, investors invest in one asset that experienced a large shock. In response to that, they move basically their capital to alternative similar assets that are not unaffected by the shock. So the competition effect kind of posits that in response to large shocks, we would see asset prices of peer assets moving in opposite directions. So inspired by these kind of mechanisms, and I'll show you a little bit of evidence of, on contagion and competition effects in different markets, what we ask here is how do these effects play in cryptocurrency markets, and do these effects kind of yield return predictability? Now, what we find is there's going to be kind of three sets of results. The first set of results is going to be that we find very clear and robust evidence in favor of a competition effect dominating in cryptocurrency markets. So when you look at kind of how the prices or the prices of cryptocurrencies move when large idiosyncratic shocks occur, and you look at kind of cryptocurrencies that experience shocks, cryptocurrencies that are peers to those shock cryptos, and all other cryptos that are non-peers, then what you see is that in the event week, shock cryptos move in one way and peer cryptos move in the opposite way. This is consistent through many different kinds of specifications that I will show you later on, and across many different types of shocks. So what we find in cryptocurrency markets, at least, is that there's a strong competition effect. So this is kind of like an effect that holds on weeks when we observe large idiosyncratic shocks. If you were to think about, well, this is kind of a mispricing, because the markets should kind of realize that these shocks are idiosyncratic. These prices shouldn't deviate that much. So what you can try to do is kind of build strategies that exploit the fact that there's potentially mispricing across peer assets. And we build trading strategies that bet on kind of the reversal of this competition effect. And those trading strategies, these are event-based trading strategies, are highly profitable. So they have Sharpe ratios of more than 2 per year, and annualized alphas in the order of 44%. Now, what we find is that what happens is what is causing this predictability is our market friction. So if you kind of restrict, if you only focus on cryptocurrencies that have kind of short selling constraints, or that are very small, very liquid, that's where most of the predictability is going to be. So what these results kind of show is that ultimately market frictions are giving rise to this mispricing and allow the mispricing to persist in cryptocurrency markets. There's of course that we know very well from stock returns, but for cryptocurrencies, we haven't really seen that. An alternative way of saying what I just said is that short selling, for example, is very important for price discovery in cryptocurrency markets. So facilitating short selling can make these markets potentially more efficient. And then the third set of results that we're going to have is basically a methodology to identify which cryptocurrencies are actually peers to which cryptocurrencies. There is no kind of standardized industry classification in cryptocurrency markets. Industry classifications tend to be pretty ad hoc by certain kind of websites. And for many cryptos, we don't even have any kind of classification at all. And even if you think about industry classification per se, for example, work that has been done for equities shows that ad hoc industries tend to be really poor kind of characterizers of peer relationships. So what we do in this paper is we try to think about an alternative way to identify crypto peers. And we do this by using online news. So I have another paper with Frank where we look at kind of like how the news reports about firms that are related to each other. And we find that news tend to really provide a lot of information about linkages across firms. So we try to extrapolate this idea to cryptocurrency markets, and we extend our previous methodology to kind of be able to identify from online news which cryptocurrencies are connected to which cryptocurrencies. we find that because cryptocurrencies are not firms, most of the linkages that we're able to extract across cryptocurrencies in the news tend to be peer linkages. So we find, for example, that it's more likely to observe a link between two cryptocurrencies that have similar ages, similar market caps, similar betas, similar trading volumes, or operate in the same industry. So from the news, we're able to very clearly identify peers. We find that the results that I'm going to show you hold even when you control for alternative ways to defining peers. For example, if you were to base your definition on kind of intra-industry peers, but those effects kind of are subsumed by our kind of peer definition once you control for that. So overall, what this implies is that the online news sources, which are available for free actually, are a rich resource to be able to identify peers in cryptocurrency markets. All right, so how does this relate to the literature? Well, there's kind of two sets of literature, two sets of results that we connect to. One is just kind of the literature on what drives cryptocurrency market returns. And we find that our results hold when controlling for factors that, that the literature has found to be significant. They hold when controlling for this kind of clientele effect that Shams has in his paper. So what we conclude is that these peer linkages are really a key driver of cryptocurrency movement. More broadly, there's a huge literature on kind of competition and contagion effect across peer assets. For equities and bonds and other kind of markets. There's a lot of paper, and for these kind of markets, the evidence is kind of inconclusive about which effect dominates and why. So we have, for equities, situations where the competition effect dominates, or situations where the contagion effect dominates. For bonds, we have also kind of mixed evidence. For example, if you think about default correlation across firms or across bonds, you can see contagion effects, meaning that two firms will tend to default at the same time, or you can see contagion effects whereby the default probability of one firm decreases when another firm defaults, a peer firm defaults. So what we do here is we kind of consider a new cryptocurrency, a new asset class, and we find strong and robust evidence in favor of competition effects. Now, if you believe that we can extrapolate from our results to a more broad general kind of market, and this was kind of the pitch that we had previously in the paper, but if you believe that is possible, then in a way, because there are no kind of credit, there's no customer supplier links, there's very little kind of linkages across cryptos, then our results kind of suggest that if you were to have two peers that are purely peers and share no other type of linkages with each other, then you would tend to see more competition effects rather than anything else. So that's kind of what we conclude. All right, so I'm gonna jump over to kind of describing how we go about getting our results. So the first step is kind of to obtain cryptocurrency data. And this is, even though cryptocurrency data generally is available for free online, it is really, really difficult to get good data. Cryptocurrency data tends to be very messy. And the way we collect our data is we kind of collect data from 3 different sources. We're going to use a site called CryptoCompare to obtain crypto characteristics. So say what industries they're in, kind of what kind of cryptos these are, whether they're stable coins, coins or currencies, and all sorts of different characteristics. And in addition, from CryptoCompare, we're going to be able to download all the news data, online news that are available online. Then CoinGecko is kind of an aggregator of cryptocurrency data across websites. And it's a very good site because it kind of, it's kind of like an open source site. So people kind of make sure that the data that is provided there is actually correct. So it provides very reliable pricing data and volume data, which is what we're going to use from CoinGecko. We also extract social media data. So for example, whether these cryptos have large followings on Twitter or any other kind of online platform. No, that's not going to be super important for most of the results. And then finally, we also use a site called Coin API, which collects all data at the exchange level. So we're going to be able to know where cryptocurrencies are traded, when they started trading, and what kind of the volume is across exchanges. We're going to focus our analysis on the 100 largest cryptocurrencies by market cap that were alive throughout the whole sample period. So we're going to exclude all stable coins because there's basically no returns with respect to USD. So we're going to have about 23,000 crypto week observations, and the sample period is going to be from October 2017 through December 2019. We're right now kind of expanding the sample to kind of keep it up to date until now. Here are some summary statistics. The sample that we have covers about 95% of the total market cap in crypto markets. There's a highly skewed kind of size distribution in this market. We have about half and half cryptocurrencies that are currencies versus coins. We have cryptocurrencies that have been very established, of course, like Bitcoin and Ethereum, but also cryptocurrencies that are very new, that are about 1 year old, that started trading about 1 year ago. We have, what's most interesting in this kind of sample is to look at the distribution of returns and volatilities. If you look at this, we have cryptocurrencies, on average, an average cryptocurrency in our sample has a weekly return of -2% and a weekly volatility of about 15%. But the distribution is really wide, right? We have cryptocurrencies that have weekly returns of -16% and others that have 6% on average. And we have cryptos that have like weekly volatilities of up to 34%. This is like a really big sample. Now, because there's such discrepancies across the return distribution, what we are going to do in order to be able to make sure that we are able to compare across cryptos is we're going to standardize everything using, at the crypto level, using a 60-day rolling mean and variance. So everything is going to be kind of standardized, and then also making it possible to kind of do our analysis. Based on these 100 cryptocurrencies we have, we're going to build a value-weighted market index. The market index kind of has a big boom at early in the sample period, a crash, and another boom. So captures kind of a good cycle. Volatilities are also all over the place, reaching between 5% and 15%. So there's a lot of different market scenarios here. And based on this market return and including other factors, so we're going to include a momentum and a size factor in the analysis that we're going to do. We're going to compute idiosyncratic returns and idiosyncratic volatilities. So what I'm going to focus most of my work on is kind of the idiosyncratic returns of these cryptocurrencies in excess of the factors that we have. But just to show you, like even these idiosyncratic returns and volatilities can be pretty big, between idiosyncratic returns of -5 to 2% and idiosyncratic volatilities of up to 32%. Okay. So once we have all the market data, we're going to proceed to identify which cryptos are peers. So we're going to use news to do that. Frank and I developed a methodology already to identify connected firms in online news, financial news. So we're going to adjust that methodology a little bit to be able to identify cryptos versus firms. And really what that involves is really changing just one of the steps in our methodology, which is kind of the matching database that we're going to use to select the currencies in our sample. But overall, once we do that, once we've adjusted the methodology, we're going to apply it to about 150,000 articles that we have from CryptoCompare. And CryptoCompare aggregates all these articles from a bunch of different websites, such as Yahoo Finance, Bitcoin.com, and so on. Here's some sample sentences that showcase kind of the linkages that we're going to identify. We have, for example, sentences that compare the market performance of different cryptos. Ethereum holds greater risk when compared to Bitcoin, as it shows greater strength during a rally. Or although the current Bitcoin trend is pretty significant, there's good reason to keep an eye on Ripple as well. So a lot of this discussion is going to be just comparing kind of the market performance of cryptos that should have similar performance, But then there's also other kind of articles that describe kind of characteristics of the cryptos. For example, BitGo, a major Palo Alto-based cryptocurrency startup, is adding Stellar Lumens and Dash to its list of cryptocurrencies that it offers custodian solutions for, signaling that the two cryptocurrencies are seen as being unique and practical enough to pass the company's selective coin addition process. So we are in the paper so far, we're not doing a lot of like textual analysis on these sentences to be able to really detect exactly which ones of these links are peer links versus other types of links. We're kind of working on that right now. But sorry, I'll jump to the network in a little bit. But what we do in the paper is try to understand if we extract one of these links from online news, what really drives the probability of observing that link in the data. So what we do is we run weekly logit regressions of the probability of observing a link between two cryptos based on characteristics of the linked cryptos, characteristics of the link, kind of characteristics of the time when we observe those cryptos, so aggregate factors, as also characteristics of, and most importantly, what we want to understand is whether differences between the characteristics of these cryptos drive kind of the probability of observing a link. If the characteristics of the cryptos are very similar, and that implies a higher probability of observing a link, then that would suggest that cryptos that are similar are more likely to be connected in the news. So that kind of points to us really extracting peer links versus other types of links from this data. So we run these regressions, and we include all sorts of fixed effects to be able to do that. And the first kind of set of results that we find is that, well, of course, news tends to be biased towards more popular and established kind of assets, financial news at least. And we observe this similar kind of phenomenon in crypto news as well. So we see that it's more likely to observe a link between kind of large popular cryptocurrencies that are highly traded. Now, so that's not surprising. That's kind of what we would expect. Now, what we really care about is kind of the differences between the characteristics of the cryptocurrencies. And there, what we find is that indeed, when the age difference is small, when the market cap difference is small, when the volume difference is small, in other kind of results, we have also when the beta difference is small, then that implies a higher probability of observing a link. We also find that when two cryptos operate in the same industry, according to the industry classification of CryptoCompare, then that also implies a higher probability of observing a link. So where all these results suggest that indeed, even though we're maybe capturing a lot of different types of links in our data, generally the links that we capture are indeed crypto peers. Now, what does this network look like? This may be a little bit hard to see. I'm going to zoom in a little bit. The network that we extract is going to have something that in economic networks is called a star architecture. So there's going to be a core of highly interconnected cryptocurrencies at the center of the network, and then smaller cryptocurrencies surrounding these big core, the big core. So the way I'm plotting this plot here is the size of a node is proportional to the logarithm of the times we have identified that crypto in the data, and the width of a link is proportional to the logarithm of the times that we observe that link. So what you see, of course, is that big popular cryptocurrencies about which kind of the news reports a lot, like Bitcoin, Ethereum, Ripple, and so on. Those cryptos are kind of at the core of the network, and they're highly interconnected. So there's a lot of kind of co-mentioning of these big cryptos. But there's a lot of smaller cryptos surrounding these cryptocurrencies in the periphery. And what we really want to understand is if at any point of time, two cryptos are linked in this network, whether that can be associated with covariation basically in their returns. So let me move forward. So how are we going to do that? Well, the way we want to do this is we need to do this kind of on an event-based way. So we need to identify which one of these cryptos is experiencing something that can be considered a shock, and how do those shock affect basically cryptos that are peers to those shock cryptos. So the way we're going to do that is we're going to define what a shock is. And we say a shock is any kind of realization of a variable that lies either in the top or the bottom percentile of its distribution across cryptos and across time on the standardized basis. So we're going to focus on negative idiosyncratic return shocks for now. So I'm going to say a cryptocurrency is shocked if on a given week its standardized idiosyncratic return lies in the bottom 10% in the bottom decile of the historical distribution of cryptos across time. Once we've identified the shock cryptos, we're going to figure out which cryptos were co-mentioned with those shock cryptos in the news. We're going to say those are the peers of these cryptos. And we're going to track kind of the performance of these two different cryptos and all other cryptos over in the weeks surrounding kind of one of these events. Based on the strategy, we have about 300 shocks that we identify affecting about 65 cryptos, and there are about 66 peers to these shock cryptos. And what we're going to do is we're going to run panel regressions for the standardized idiosyncratic return of different cryptos, controlling for both whether one of these cryptos is shocked, whether one of these cryptos is a peer to a shocked crypto, all sorts of controls, including kind of aggregate controls and crypto level controls, as well as kind of fixed effects that account for potentially emitted variables. We're going to repeat this kind of panel regression in the 2 weeks, each of the 2 weeks surrounding kind of an event that we observe in the data. Now, what we really care about is, in a way, this parameter here. Let's see. These two parameters. So essentially the coefficients on the indicator, whether some of these cryptos are either shocked or peers. And in particular, we care about these coefficients in the event weeks. So if in the event weeks, these parameters are significant, then that tells us that there is kind of co-movement along these peers. And the sign of the coefficient is going to tell us precisely which mechanism is kind of mostly at play. So if the sign of these two coefficients is the same, then that tells us that peers of shock cryptos and shock cryptos co-move in the same direction when a shock occurs. The sign of these cryptos, of these coefficients is the opposite, then that tells us that kind of these cryptos co-move in opposite directions. That would point kind of towards a competition effect. So we're going to test that these hypotheses in the data. So here are kind of the results of our estimations. So we repeat this panel regression each of the weeks surrounding an event. And in the event week, we find that indeed these coefficients are significant and the sign of these coefficients is opposite. So that points towards kind of a competition effect dominating the co-movement of these cryptocurrencies in the event week. It's good to see that there's no significance in these coefficients in the week before an event, suggesting that there's kind of no informed trading driving some of these results, or no sophisticated informed trading driving these results. And we don't see any significance in the weeks after an event, suggesting that this is really an effect that's concentrated just on the event week. These estimates are all based on standardized idiosyncratic returns. So if you look at kind of what this implies for nominal returns, we find that one of these shocks that affects a crypto means that that crypto is going to have about a minus 16% idiosyncratic return in that event week, while peers are going to experience 1.4, an idiosyncratic return of 1.4% in excess of kind of the factors that we have in our model and all sorts of characteristics that we're controlling for here. So what happens around these events that we have in our data? Here's just some kind of illustrations. We look at kind of how often these cryptos are mentioned in the news in the week surrounding an event, and what the trading volume is of these cryptos in the week surrounding an event. And what we see is that when you look at kind of cryptos that experience a shock, they are highly mentioned in the news. So there seems to be kind of information that's being processed about these shock cryptos here on the top middle plot. And there also seems to be some trading in response to this information. So if you look at kind of the abnormal log volume, trading volume in the weeks prior to an event seems to be significantly high for cryptos that experience a shock. So there seems to be some sort of trading happening that's kind of causing some of these the shock that ultimately realizes in the event week. When you look at kind of the peers of those shock cryptos, you see that they are not necessarily more often mentioned in the news in the weeks before an event, but they do experience abnormally high news mentions in the week of an event. So the news seems to be reporting about, well, there was this shock that affected this given crypto, and these are the peers of those cryptos. So there's more news activity for peer cryptos. And if you look at kind of the trading volume of those peer cryptos also experience abnormally high trading volume, both in the event week and the week after an event week. So investors seem to be responding to this additional information that's being released. Non-peer cryptos don't seem to behave like that. So they don't seem to have abnormal behavior in the weeks surrounding an event. And the red line here, I forgot to mention, is kind of the market. So we really tend to see that peer and shock cryptos perform differently than the market in these weeks. So in the paper, we go through a lot of work to try to figure out what can drive this kind of, this co-movement. We find that alternative linkages between cryptos do not seem to be driving the results. So if you look at if you think about cryptos being peers when they're in the same industry, that doesn't explain our results, even though this coefficients go in the same direction. If you believe kind of this correlated demand shocks as in Shame's paper, that also doesn't seem to be explaining our results. So there seems to be something here that is in excess of what these other channels can capture. If you believe that, well, most of this is because, or if you believe that maybe the shocks that we identify are not good shocks to be testing this, we run kind of tests where we classify shocks, or we kind of rank shocks according to how likely it is that these shocks are systematic. So we look at how strongly the market co-moves with these shock cryptos. And there again, we find that, well, yeah, if shocks are most likely to be idiosyncratic, you're going to observe most of kind of this co-movement. And while if the shocks are more likely to be systematic, you might observe kind of contagion effects, but they're very weak. So what these results suggest is that there may be contagion effects in crypto markets, but they're really only in response to very large kind of systemic kind of shocks. And those we just don't observe that much. Consistent with kind of results that have been shown for stock returns, we find that that the competition effect seems to be mostly concentrated on smaller peers, which have some like slower information process diffusion. So again, if you break down kind of how the peers behave in response to shock cryptos, whether they're larger or smaller than these shock cryptos, then we tend to see most of the activity in peers that are smaller than shock cryptos. And then finally, we repeat kind of the same experiment for alternative type of shocks. So instead of looking at negative idiosyncratic shocks, we look at positive idiosyncratic shocks. So idiosyncratic returns are in the top decile of the distribution. And there we find, again, competition effects just in the opposite way and slightly weaker than what we find for negative shocks. There's, of course, a lot of behavioral theories that may explain why the response to positive shocks is different than the response to negative shocks. And then also, a lot of the shocks that we include are not necessarily, it's hard to tell whether these shocks are actually informational shocks, whether they're kind of releasing information to the market that needs to be processed. So we classify shocks again into whether they are clearly informational by also ranking the shocks according to kind of the amount, the news frequency basically of the different cryptos in the event week. There again, we find that if you focus on shocks that are clearly informational, you're going to find, again, competition effects, regardless of whether you look at kind of negative or positive shocks. So these results really show pretty robustly that the competition effect really seems to dominate among cryptocurrency peers in crypto markets. Now, I'm running kind of out of time. I'm going to go a bit quickly now. Well, this is of course great. Now, if you know this though, one thing as a finance person that you may want to do, of course, is try to trade this away. So what we do is we look at whether there's predictability kind of that arises due to these competition effects. So what I'm showing here is kind of the realized return or the cumulative realized return of these peer cryptos and the market in red in the weeks after we observe a link. So what you see is that on an event week, of course, peer cryptos in response to a negative idiosyncratic shock jump up because there's a competition effect, but it takes the market about 4 to 5 weeks basically to trade away kind of this effect. Only after 4 weeks, basically, the cumulative return of these cryptos is indifferent from the cumulative return of the market. So these cryptos need to kind of come down. There seems to be a reversal of the competition effect that we've identified. Now, this is the case, of course, you can try to trade this away. So how would you do that? Well, you can construct a trading strategy that exploits kind of whether there is a shock and whether there are peers to these shock cryptos. So the way we're going to do this is each week we are going to look at which one of these cryptos has idiosyncratic returns that lie in the bottom decile of the at that point observed historical distribution of standardized idiosyncratic returns. So this is kind of, it's not looking ahead in any way. So we identify kind of these set of cryptos that are shocked. And then we're going to see whether in that week, there are cryptos that were co-mentioned in the news with those shock cryptos. And if there are, we're going to short sell those cryptos in order to bet kind of on the reversal of the competition effect. We're going to hold these short positions open for several weeks, which we're going to call the holding period. And we're going to repeat this on a rolling basis. So each week, we're only going to be able to invest a fraction of the available wealth to make sure that this portfolio is self-financing. So what happens when you do that? Well, depending on how long you hold your position open, the performance of these strategies are going to be pretty different. But if you really hold these positions open for about 10 weeks, that seems to deliver kind of the highest performance. So if you look at kind of this table, as trading strategy that keeps these short positions open for 10 weeks has an alpha of about 80 basis points per week, no factor exposure, and a Sharpe ratio of about 2.3. These are all performance after fees. So we assume basically that it cost about 2 basis points to open a short position, 84 basis points to maintain the short position open per crypto for a week. And then there's a bid-ask spread of about 50 basis points. These fees are kind of fees that we extracted from Kraken. So these are kind of actual short selling fees that market participants pay. And a 50 basis point bid-ask spread is kind of an average bid-ask spread for the most liquid cryptocurrencies in this market, according to Antoinette Shore's kind of papers. So this is pretty significant. I mean, a Sharpe ratio, analyzed Sharpe ratio of 2.3 is pretty high. So why is this the case, right? I mean, it seems kind of implausible that it would be so easy to kind of construct a trading strategy with such a high Sharpe ratio. Okay, so what we conjecture is that, well, there's got to be kind of market frictions preventing people from trading this away. So what we're going to do is we're going to repeat construct these trading strategies by restricting the trading strategies to only a subset of the cryptocurrencies. And we're going to rank these subset of cryptocurrencies according to the degree of kind of market frictions that they may face. So the first kind of subset of cryptocurrencies that we're going to consider are all the cryptocurrencies that you can short sell easily on Kraken. Kraken is a big cryptocurrency exchange that allows short selling on margin. And if you look at that, this same trading strategy on Kraken does not really provide and derive any alpha. It has a negative market beta, and it has a Sharpe ratio that's about like less than half than what we are able to do with our original trading strategy. Then we consider a trading strategy that only trades cryptocurrencies that are larger than the shock cryptocurrencies. So these are cryptocurrencies that are likely liquid, but not necessarily available for short selling because we don't know whether these are available on exchanges that have margin trading. And there again, you see that the trading strategy in that kind of subset of cryptos does have a significant alpha, but a lower Sharpe ratio than what we are able to do with our strategy. And then finally, if you focus just on on short selling kind of cryptocurrencies that are smaller than shock cryptocurrencies, so these are the most likely the cryptocurrencies that are hard to short sell because they're small, that are illiquid, highly volatile, then you see that really the whole performance of our strategy is really coming from these kind of smaller cryptocurrencies. So what we see is that market frictions really seem to be driving this persistence in the competition effect that drives this mispricing. And just by looking at kind of this table here, the results kind of suggest that the ability to short sell is what facilitates kind of market efficient or price efficiency in these markets. So preventing short selling in cryptocurrency markets may give rise to these kind of mispricing that we've uncovered here. All right, so that's all I have. So what we show here is that the competition effect is a key driver of crypto return covariation. This holds after controlling for risk factors, for kind of clientele effects, or for systematic kind of shocks. And it seems to be concentrated primarily on smaller peers. We find that the competition effect is transient and it yields predictable returns. So if you wanted to construct trading strategies that exploit the reversal of that competition effect, they tend to be highly profitable, but they're hard to implement due to market frictions. And then finally, we develop a methodology to identify kind of crypto peers using online news. And that's all I have. Thank you.
Right, great. Thanks very much, Gustavo. That was great, right on time.
Absolutely.
Well, our discussant is Daniele Bianchi. Daniele, you can share your screen and begin.
Can you hear me?
Yep.
Yes.
All right, so thanks for having me discussing this paper, and thanks Gustavo for writing the paper. Actually, it's very interesting. I liked it a lot and actually learned a lot. So Gustavo did obviously a great job in summarizing the whole thing. So I'm not going to repeat the results here, but I want to put everything in perspective, if you wish. So the first question is why we should care. So why we should care about cryptocurrencies in the first place regarding competition versus contagion? Well, the obvious answer here is that it's probably the most concentrated market you can think of. If you just take the market capitalization of Bitcoin and Ethereum together, they cover 70% of the whole market. And if you look at by comparison, for instance, for equity, if you put together Apple, Microsoft, all of the big tech firms that you have out there, they cover, just shy 20% of the S&P 500. So there is a huge gap in terms of concentration when you look at cryptocurrency markets versus the others. So makes cryptocurrencies sort of the natural environment, if you wish, to investigate contagion versus competition. So the goal of the game here is try to separate the two effects. So you have an idiosyncratic shock or news, and then you're going to have contagion if that idiosyncratic shock has market-wide implications. So market-wide or industry-wide, if you wish, repercussions. And that could be because of fundamental linkages or just because you see the idiosyncratic shock are threatening the whole industry, for instance, so that prices react in a similar way. And we actually have that in the cryptocurrency market very recently. So just a few days ago, September the 2nd, 2020, there has been rumors that South Korean authorities seized the second largest Korean exchange, which is called Bitham, for fraudulent token sale. So that's a sort of an idiosyncratic event because it relates to a single exchange for a single token sale, not related to any of the other, but that generates a market-wide sell-off. So I'm reporting here, for instance, the losses of Litecoin, Chainlink, Tezos, and Ox, which is completely unrelated to each other, but they all lost more than 20% of value in 2 days, basically. Now, the other opposite story could be that, okay, you have an idiosyncratic shock, but then you have a competition effect, which means that a shock to a given currency is seen as beneficial for the others. So other competing firms or digital assets, as in this case, they might increase their market share. So there is a rebalances of profits, cash flows, growth opportunities, so that prices react in the opposite way. And again, we had an example of that a few days ago, was August 31st. And there was this news that Band Protocol is a so-called Oracle blockchain integration platform. They signed up a strategic partnership with one of the main competitors of Ethereum, which is called Tron. And right after they signed that strategic partnership, you see the divergence of the price of Band with one of the strongest competitors, which is called Chainlink, completely diverge. And you see here the yellow line basically is right at the announcement of the sign of this strategic partnership. So you have two competing digital assets. One of them is hit in this case by a positive shock, and the other is not. And you see price divergence. So what Gustavo and Hanan is pushing here is the idea that on average, if you look at a large cross-section of firms for a relatively long period of time, you see the second effect dominating the first one. So I'm going to comment on four things, hopefully have time. So competition, what do we really mean here by competition? The role of Bitcoin and Ethereum, how we can eventually link the phenomena that we see with, two things that are well established in cryptocurrency markets, which is ownership concentration and how long you actually hold a digital asset and peer distance. So when it comes to competition, I actually thought hard about it, and it was not clear from the beginning if we are actually capturing competition here. So I went back to the early studies by Lang and Solz in the 1992 actually define a competitive effect. Is okay, there is one announcement that hit a particular firm, and that announcement basically revealed the type of the firm. And the other firms that are competing because of services and products, they're actually benefit of that shock because that creates for them profitable opportunities, right? So basically increasing the growth prospects in relative terms with respect to the firm that is hit by the shock or the announcement. So the ingredients for a competitive effect, at least my understanding, is that you have to have a relatively concentrated sector that should be after the shock, some sort of rebalance of profits, cash flows, or in general market share. And the rebalance of profit, cash flow, market share is basically due because these firms are competing for the same customer. So the product, they have similar products or similar services. Examples are Facebook versus Twitter, Apple versus Samsung, but you could do many. So in these papers, you definitely have the one concentrated sector. It could make sense. It could be that, if anything, because of capital flows, capital floating from one crypto to the other, you have changes in the market share, but I'm not 100% sure that here that change in the market share is due to the fact that one competing firm is winning versus the other when they're actually competing for the same type of customers, as in the general or standard definition, if you wish, of competition, at least the way I understand it. So in the paper, what they do, they have this interesting machine learning framework where they do basically some sort of textual analysis, and they extract peers based on, how they are, linked through the news effectively. So what I'm reporting here is an example, arbitrarily taken, randomly selected on August 25 on CoinDesk. And the point of that article was explaining how Aave, which is a peer-to-peer lending platform, and Maker, which is a governance token, are to some extent, they were compared based on how much collateral they have stacked on Ethereum. So if you look at the article and the first reading, you may think that they're actually related to each other, but in fact, they are almost unrelated to each other, Aave and Maker. In fact, as I said, one is a lending platform, the other is a governance token for a stablecoin. The only link between the two is the fact that they're both built on Ethereum, right? And if I look at the examples that are in the papers, I'm highlighting here table 6, some of these links makes perfect sense, like for instance, Bitcoin, Litecoin, Ripple and Stellar Lumens, they are both, for instance, Ripple and Stellar Lumens, they are both peer-to-peer payments, but others like Bitcoin versus Ethereum are not competitors in the true sense of the word. For instance, Bitcoin has been built as a payment, peer-to-peer payment, for instance, but Ethereum is a smart contract, builds smart contract functionality. So they are completely unrelated in terms of the target that they have. So the question that I had, or the thought that I have, is that okay, that there could be possibly a non-trivial set of peers that are not true competitors. So can we actually exclude that here we're not capturing risk shifting behavior, substitution effects, from an investment perspective that generate divergence between peers. And this could be especially relevant since the way you do this interesting analysis based on logic regression, it turns out that peers are clustered, they have similar market cap, similar trading volume, so they might be perceived similar from an investment perspective, but they are not from a true economic fundamental perspective. So I was wondering if there is a way to disentangle the two things. And there is shifting behavior, or there is shifting story, if you wish. There is some anecdotal evidence. So what I'm highlighting here, it's an article that appeared on Cointelegraph on August the 7th. There is, especially by market commentators, there is this idea that there is an inverse relationship between the dominance of Bitcoin and how much valuable are alternative coins. For instance, what I'm showing here is the market cap of Bitcoin versus the market cap of all of the other alternative coins except the top 10 in terms of market cap. And you see that there is some sort of inverse relationship. So when Bitcoin tends to dominate more the market, the weight of the alternative coins tends to decrease, and the opposite. And the fundamental trading reason for that is that when you have a run up on prices in alternative coins, you tend to cash out and put your money in Bitcoin, and that creates some sort of inverse relationship and ultimately correlation. So, as you said in the presentation, it's 100% true. Clustering cryptocurrencies is difficult because it's much more messy than you think. But perhaps we could focus or narrow down the analysis, or some part of the analysis, on peers which openly compete with each other because they explicitly say that. For instance, when it comes to smart contract, Cosmos, Tezos, they openly compete with each other. Or now there is this wave of so-called decentralized finance applications, and there is a list actually. I think CoinMarketCap has an index where you can see all of the components of this index, and they are all competing for the same funds. So at the end of the day, they compete for the same money, so they can thought really as competitors in that sense. So then the second comment that I have is, what is the role of Bitcoin and Ethereum? Because it goes without saying that Bitcoin and Ethereum dominates the crypto market, and this is true for fundamental reasons. If anything, because Bitcoin is seen as the most valuable investment vehicle, if you wish, and Ethereum actually is the building block of the whole initial coin offering system, so for the whole token systems because of smart contracts. So this generates two consequences. Most of the news cover Bitcoin and Ethereum, and this is something that you actually show in your paper, which is nice. So most of the media mentions are Bitcoin and Ethereum together with others, but the both is there. And there's a secondary consequence is that if you, whatever evaluated market portfolio you think of, highly correlates with Bitcoin and Ethereum. I showed at the beginning the dominance of these two in terms of market value. And you can clearly see, if you just do a scatter plot, as I did here, of returns. I'm taking monthly returns from July 2015 to July 2020 on the market. The market index is constructed using top 100 cryptocurrency by market value, and you can clearly see that there is correlation. The left side shows Bitcoin versus the market, the right side shows Ethereum versus the market. So there is definitely highly correlation with Bitcoin and Ethereum and whatever market index you can think of. So the comments that I have is that, okay, could be working with excess returns. So if you take out the market, could perhaps, I might be wrong, but could perhaps skew the results towards smaller, lower betas. And if anything, what I was expecting is, okay, do the results, the competition effect holds, even if you exclude Bitcoin and Ethereum, which are clearly dominating any empirical effects you see out there. I'm not sure. You control for sites in your empirical analysis, which is obviously good, but I'm not 100% sure that this is good enough, if anything, because there is a huge level factor in crypto, which is Bitcoin. Now, the third comment that I have is these interesting results that you have this short-term mean reverting effect in in the price divergences between shocked cryptos and linked peers. And the question that came to my mind is, okay, how can we think about in terms of investment behavior? So is this a short-term deviation that is due basically by speculation, or again risk shifting? So you have this transitory competition effect. The shock peer decreases in value quicker than linked peers, and the reaction goes back to the average returns on the market after a few weeks. So if I think about investment behavior, it could be that this is linked by how much sort of speculative capital there is out there for a given crypto. What I'm plotting here, for instance, is the ownership by time held for Bitcoin over the last year, basically. The blue bar means the fraction of the coins out there that are held by for a period that is longer than a year. The red part for a period that goes from 1 month to 12 months, and the yellow for a period that goes less than 1 month. So that gives an idea of how much short-termism, if you wish, there is in the ownership of a given currency. And not only the cryptocurrencies are the same. Bitcoin is basically long-term holders against the conventional wisdom. But if you see others, for instance, it's much more sensitive to short-term speculation, because you see the fraction of people that has currencies for lower periods, shorter terms, is much higher than for instance, for Bitcoin. And that's ultimately coupled with the ownership concentration. So the fact that you have capital floating around in different percentages across cryptos. So again, what I'm plotting here on the left side is the ownership concentration in Link, which is one of the cryptocurrencies you have in your sample. And as you can see, almost 70% of the coins out there is held by basically 10 wallets, while for Bitcoin is much more dispersed, the ownership concentration. So those things can actually sort of justify or can explain, if you wish, why you have the short-term reaction on average. But it would be nice, for instance, to see if there is any heterogeneity you can add in that question or comment that I have, if you wish, is can we actually delve further? And if the short-term reversal effect that you find, it's a function of how much floating capital there is on a given crypto, because ultimately that could be related to the point that I made before, which is risk shifting or speculation. So the last comment that I have is about peer distance. So I think it's kind of intuitive to think that, depending on how far a digital asset or a cryptocurrency is from the shocked one, the reaction of the investor should change. For instance, Bitcoin could react more to a shock to Litecoin, that it's direct competitor, in fact, than to a shock to a small crypto, despite being perhaps related because of they are mentioned in the same article in the news. So you have this nice plot. So you have this network, star network in the paper. But I mean, even at the first sight, you can think about a very distant crypto from the core of the network. A shock to that crypto could be very different than a shock to a central node of the network. And I was wondering if there is a way to capture such heterogeneity in distance. So perhaps you can disentangle the effect of a shock closer versus distance based on some network centrality measure. You have plenty out there, for instance, like between centrality and closeness. And this not only from a regression perspective, but also when you construct your trading strategy, which is carefully designed. But perhaps you can add some sort of heterogeneity more, for instance, double sorting based on how a crypto is distant in the network from the shocked one, and perhaps controlling also for market size, which turns out to be a very important driving factor behind the whole thing. So it's recommended reading if you want to understand more on crypto. Very interesting paper, and hopefully my comments are useful. Thanks.
Thanks very much, Daniele. I let you run a little over because you had so many good comments. I was curious to hear them all. So, Gustavo, maybe you would like to take a minute or two to respond, and then we can proceed from there.
Yeah, I mean, this is great, Daniela. I really want to know where you got the data on the ownership structure of those cryptos. That's really interesting. And the centrality comment, I think, is also a good one. I didn't think about it. It's actually a pretty good point. And we have all that data, so we can do it. I agree with the product competition. It's kind of difficult to really define proper peers, I guess. And this is kind of where we rely in parts on industry classifications that look at that. It definitely could be, if we have alternative ways to defining kind of what actual product market competition would be, it might be better. It may just be more ad hoc that we have to do it manually. Yeah, definitely agree that that's a good point, that we need to do a little bit more carefully. And ultimately, I think one of the things that we're moving a bit away, and I think in the next version of this paper we're going to do, is just, it doesn't matter really where you identify these peers, the peer linkages from, as long as you know that they're peers. So we just have one way of doing this, but definitely we should have alternative ways of doing it just to provide robustness. Yeah. But yeah, that was a great discussion for sure. Yeah. Thank you so much.
So if I may add, I guess my comment on competition was, okay, I think you have definitely few, because I agree 100%, it's difficult to cluster peers, but you have few clear cases. And perhaps just, just highlighting a couple of like anecdotal evidence, really, not full-blown empirical analysis, to further push the argument, I guess, because there are a few clear cases there.
Yeah. We're running some like textual analysis now just to be able to really extract the ones that are clear peers. Like that example that you showed, I'm hoping that in the work that we're doing, we're going to be able to kind of exclude some of these linkages that are not peers. So that's something that we're working on for sure. Yeah.
All right. Well, I think we've run a little late. Maybe this is a good time to end the formal seminar. So those of you who'd like to stick around for a couple of minutes, and we'll upgrade everyone to panelists, and then we can talk a little more. Before I end the video, let me say to everyone, thanks very much for watching today. And then also let me give a little advertisement for the next SoFiE seminar. The next SoFiE seminar, we'll have Natalia Bailey as the speaker. She's at Monash University in Melbourne, and her discussant will be Simon Freyeldenhoven, who's at the Philadelphia Fed, and who's Dutch. You could tell from that last name. So that's in 2 weeks' time on September 21st. Please join us then. In the meantime, stay safe and well.